Come on up, Esther. Yeah. Great. Here, you can stand up. Yeah, I'll introduce you. Hey guys, thank you for joining us tonight. We're slightly behind schedule, but we have a great evening. We have the place until 10 o'clock, 8:30. We'll go back out upstairs to Refraction on the 8th floor. We have a great panel, and we have 9 awesome presenting companies. I want to thank our sponsors. They are listed in the program book. First and foremost, Fairfax County EDC, or EDA. Fairfax County EDA, thank you. And also Refraction, which has the best co-working space in the area. I've been here 3 years now, I think. It's upstairs. We have a koi pond out here, a pond for jogging, great food, and it's just a great place. So anyone's looking for a Virginia location, if you live in Maryland or whatever, like I do, this is perfect. I'm going to shout out our partners because these guys are the ones that make this event possible. We have Forbis, Ling, right here, and Will Choi. You'll be hearing from them soon. We have AEG, Mark Haas. We'll be hearing from Mark as well. And I'll just keep running through here. We have New York Life, Next, powered by Shulman Rogers. I want to shout out Buzzy Rocket. Buzzy Rocket's our new sponsor. Marketing right there, please. Thank you so much. Entrepreneurs Organization, Maryland Tech Council, Ryan and Wetmore, Enterprise Transformation Solutions, Startup Grind, the annual Wharton DC Summit, which will be in Roslyn, Virginia on June 22. I think we have some of the Wharton guys here, so please sign up. You can find it online. Kobe, Truist Bank, Keiretsu Forum, National Association of Business Owners and Entrepreneurs. We have the Northern Virginia Chamber and the Northern Virginia Tech Council. Robert A. Smith School of Business, the Dingman Angels, U.S. International Development Center, FITSE, Institute for Excellence in Sales, Founder Institute, Center for Advancing Innovation, and Georgetown Entrepreneurship. Let's give it up for all of our awesome sponsors, please. Thank you. Without further ado, let me turn over to Esther Lee, who's the former Secretary of Commerce for the Commonwealth of Virginia and the CEO of Refraction. Esther, thank you for all your support.
Thank you, Tien. Welcome, everyone. What he didn't mention is I'm lucky to have Tien on our board. He's, as you all know, one of the most connected, most successful entrepreneurs in the region. He's done so much, along with another board member, James Quigley, in terms of strengthening the innovation ecosystem in the region. Again, I'm Esther Lee. I'm the CEO of Refraction. We're a nonprofit innovation hub co-working space just upstairs. We're actually giving tours all night. And afterwards, I invite you to join us for the after party at 8:30. I think last time we went to like midnight, which is kind of late for me, but those of you who like to network and continue to network, please join us. So as Tien mentioned, I had I was fortunate to serve as Secretary of Commerce, where we helped bring Amazon HQ2 to Virginia, and got to work with great people like Tom Weitzman with the Virginia Innovation Partnership Corporation. I think actually the Commonwealth has done a lot to help startups, and even more so now. And so we're very lucky to have you, Tom, in your role leading the Virginia Venture Partners. So if you haven't had a chance to meet Tom, please do so. Refraction provides mentoring through an exclusive network of mentors. We've got serial entrepreneurs, people like Tien, investors, sales and marketing executives from large companies, financial strategists, and others that give back their time by helping our member companies. I think more important than that is we help make introductions to customers, to pilot projects, to investors and others. And so we are kind of a unique, I don't even know how to term ourselves, but we've been really thankful to work with some great companies. And so I hope you'll consider joining us, or at least coming to some of our events like this one. And then one last thing about the building. I mean, you see how beautiful our building is. Beyond that, there's a huge gym that has a Peloton, golf simulator. You know, it's open 24/7, and our members get to use that for free. There are basketball courts, tennis courts, free Uber rides, and so much more. So I just wanted to say, if you know of startups that are looking for a great community to join, please let us know. We've got a table out front. And again, we're a nonprofit, so we're really in this to try to help grow more high-paying jobs in the region and in the Commonwealth of Virginia. So thank you for coming. And I also want to introduce my partner in crime, Christy Uke, who is heads up business development for the Fairfax County EDA, where I used to serve on the board. And you are all doing amazing work, bringing great companies from all over the world, actually, to Fairfax County. And thank you for supporting this event, Christy.
Thank you, Esther. Hi. My name is Christy Uke, and I am with Fairfax County Economic Development Authority, and we are 100% funded by Fairfax County, and our goal is to attract technology companies to our area, as well as the companies that are here to make sure that they're happy being in our county, that they don't go elsewhere. So in order to do that, we provide various services, and so we meet with the executives once a year to see what their challenges are, what the goals are, and we try to match that up with different resources in the area. So, for example, you say, okay, I think we're now ready to go to government contracting. We will, provide you with some of the resources available and training and counseling for government contracting. And let's say you're looking for, trying to move to an office space. We would, provide you with various office space locations in the area. And all of our services are at no cost to businesses, so take a big advantage of us. And we love working with technology companies. And so best of luck to all of you guys today. Thank you.
There we go. So thanks for having me. Love speaking to entrepreneurs, and we want to impart as much information as we can to you. So we're going to make the introductions very brief. I've also got a list of audience questions here, and we're really looking forward to covering a broad range of topics. I'll just ask everyone to do a 60-second introduction, maybe even 30. I'll go first. So Randy DeMolke, I'm the co-founder and the managing director at the Private Access Network. We make venture capital investments as broadly defined. I've been an investor for 23 years. I've written 7 checks so far this year, and we've got a portfolio of about 25 different companies that revolve around information technology, SaaS software, and e-commerce. Ben?
I'm Ben Katz. I'm managing partner at Sentinel Ventures. We do seed to Series A. Almost exclusively focus on the resilience of our infrastructure, so we have somewhat of a niche fund.
Great. Dana?
Wow, that was really efficient.
Yeah.
Hi, Dana Goldstein. I'm general partner of the Halcyon Fund, chief investment officer of Halcyon. Halcyon is an early stage incubator in Georgetown. We've been incubating impact-driven ventures since 2014. A couple of our incredible founders are here tonight, so please meet them, talk to them. We have a seed stage fund as well and an angel network, primarily looking at companies in climate, health, what we broadly define as equity tech, which is anything that is closing a gap. I'm a 2-time entrepreneur, so happy to speak from both perspectives.
So I have acronyms, so by nature we'll be less efficient in my introduction. Tom Weithman with Virginia Innovation Partnership Corporation, formerly known as CIT, and more specifically with Virginia Venture Partners, formerly known as CIT Gap Funds. We are a Virginia-sponsored family of funds. We invest in seed and early stage companies around the Commonwealth. We've been doing this for about 17 years, and so have made upwards of 300 investments. We have an active portfolio of about between 180 and 190 now. I've lost count. That are investing at a pretty aggressive space in seed stage. We do tech, we do life science, we do clean energy, we've done some aerospace, some autonomy, a lot of cybersecurity, other assorted deep tech. Now, for the first time with the provision of some federal funds through the Treasury Department, we will be investing in like-minded seed fund managers to help bolster the risk capital infrastructure in the Commonwealth.
Great. Thanks very much. So, like I said, we want to impart as much information as we can. So I'm not going to do what a lot of people do and ask all 3 of us the same question. So let me start off with a question for Tom. A lot of entrepreneurs have reported that it's much tougher to raise capital for their companies. And so I'm wondering if you can just address, kind of yes or no, does it seem like that's true from the investor side? And then can you give a little bit of an explanation as why that's true, or if you agree with me, why that's true, and kind of what's gone on to lead to the situation that we're in today, where it probably, giving away the answer, but it probably is a lot harder to raise capital than it was 18 or 20 months ago.
So I think the answer is it depends, right?
Yeah.
It is certainly, and I don't think it's uniformly difficult for founders to raise capital as a function of sector, and sadly as a function of demographic. I think we are turning the clock back to where we were pre-COVID in terms of difficulty, challenges faced by women entrepreneurs, by founders of color, minority entrepreneurs, immigrant entrepreneurs. And I'll just put in a plug for the federal money, the SSBCI money that we're administering has a little bonus. We get a little bit more capital to work with the Treasury if we can invest a certain amount in what they call SETI founders, socially, economically disadvantaged individuals, founded companies. I think it's difficult for companies that raise capital and are looking for another slug, either a bridge or a B round, who raised first half of 22 or earlier at inflated valuations. It's difficult to pull those insider rounds together. You hear more later stage investors saying no. Seed, is where we play. I think we often consider somewhat insulated from macroeconomic trends, but not inescapable. And we see valuations depressing a little bit, with certainly in things we've invested in at a very early stage in our portfolio, and the new companies that we are seeing. So it's an investor's market for them that have capital. However, you look at where the capital's going, and you see that it's getting concentrated with experienced managers in very large funds, upwards of $500 million. I think in the first quarter of this year there were 16 micro funds formed. We're trying to alleviate that as well. Putting in a plug for what we're doing with this Treasury money by investing in seed stage managers. So it's a really complex environment. But the short answer is yes, but generally become more difficult.
Yeah, that's great. Ben, yeah.
I think what's always been true is that good founders, people that are repeat founders, good tech, good plans are having less of a problem raising money. It's the frothy times of the last 10 years that have come to a close.
Yeah, so I think the message for entrepreneurs is it has been and it always will be a meritocracy. There really aren't, secrets and shortcuts. You're wondering why you're getting funded. It's not getting funded, right? It's some combination of the content of your pitch and the reality of your company. So, just always try to be the best you can be. Get your story out early and often to as many people as you can, and be very open to constructive criticism, because we can all be better. There's no such thing as unable to be improved upon. So, Dana, you're doing things that are a little bit more focused on, DEI type stuff and, B Corporation type stuff. It seems like that was a little bit more sexy, if I can use that word, without a gender context, but, it seems like that's a little less sexy in 2023. Have you seen that? I mean, I'm just going by the headlines, right? Because we don't focus on that. Is there any truth to that? And how can entrepreneurs that are practicing in those areas make a course correction?
So I would argue that investing in great ideas is always sexy. And one of the things that we really focus on, thank you. Definitely talking to the right audience here. We actually don't explicitly focus on DEI, but we do focus on impact. And the areas that we're interested in, climate, health, and equity, tend to disproportionately attract underrepresented founders. That's actually super exciting to us, and I think there is still a ton of opportunity. First of all, climate continues to be kind of the hottest industry. I don't have the stats off the top of my head, but a large percentage of checks that are being written at seed and A stage are being written into climate tech companies. So that area certainly remains hot. But one of the things that excites us, and I think excites a lot of investors, for us it's all about finding alpha, right? You're looking for opportunities to make money. That's why we're in this from an investment perspective. Finding entrepreneurs who are being overlooked by other investors is actually a phenomenal opportunity, and it remains a phenomenal opportunity. So we take that lens. From the perspective of an entrepreneur, a way that you can stand out, a way that you can get access to capital is by showing that it's going to be a great investment. And one of the things that I think has shifted a little bit in the last 18 months, I guess a couple of things, and Tom, you alluded to this, there is a shift towards more kind of investor power, I would say, and I sort of hate the power dynamic, but it's there. As investors, we're able to be a little bit pickier at the moment because both the perception and the reality of kind of a slowdown in capital, deals are moving a little bit more slowly. You all who are looking for capital are a little bit more desperate. So we're able to be a little bit choosier. We're able to dictate the terms a little bit more. In some ways, I think it's actually good for the sector. I think some of the inflated valuations are coming down. But it also means that a lot of us are looking for companies that have great unit economics. We're looking for companies that are highly capital efficient. If you're running a capital efficient company and you can show investors that, hey, we're at a point where we've figured out who our market is, we've kind of found that first product market fit, what we're looking for is capital that's going to fuel the fire. It's a super exciting opportunity, and it's a great time to be raising, I think, regardless of what industry you're in.
Yes.
Maybe that will fuel the fire and a controlled burn so that they know exactly where to go.
Yes.
Right? Because money without a plan
That's right.
is less sexy.
Absolutely.
Yeah.
Are we going to keep going down the sexy path here? Is
Yeah.
that, okay, as long as we play the groundwork.
So let me mention something for the audience. Dana mentioned a couple of, what I call buzzwords. One was unit economics. The other one that she said was we're looking for alpha. And you, as entrepreneurs who are trying to, speak to us, you gotta speak and learn our language. And so let me just explain alpha a little bit. Dana said we're looking for companies that can deliver alpha. What that means is a risk-adjusted premium over other areas that we can get a return. So if the government bonds, which are essentially riskless, but for the shenanigans of the past couple of weeks, essentially riskless, if they're paying 5%, and you are offering a return of 10, it's not the nominal difference, it's the risk-adjusted difference. So your companies, by definition, are insanely risky. So if I can get 10 from the government, I should get 20 at a minimum from you just to break even on a risk-adjusted basis. And if you can offer me 25, that's an alpha of 5. That's actually incremental return, not just nominally, but on a risk-adjusted basis. And that's what we're looking for as investors. So anyway, that's kind of a buzzword that investors will throw out, and you should understand and not just say, oh, well, I can deliver 20 instead of 5. No, if I risk adjust, I probably need 20 at a minimum. Hopefully you're giving me 25 or 30% on an annual basis. Well, here's another question, and I'll throw it out to Ben. Have you seen the terms for deals? So we can kind of agree it's more difficult to raise money. I don't have to poll the audience. I'm fairly sure they'll agree with me. But Ben, have you seen, even for the deals that get done, that any of the specific, traditional terms have changed? Valuations, preferences, interest rates, board participation?
Yeah, I think there'll be broad consensus, at least among us, right,
Yeah.
that valuations have started to come down. I don't think they've come down as much as maybe some of the media has been talking about. But I do expect, and I'd like to hear from the other panelists, is that I do expect valuations to continue to have some downward pressure over the summer, and that might guide you on some of your raises.
Yeah, so Ben is actually alluding to a good point, which I'll just mention, even though I'm the moderator here, is that the market is going to set the price for your company, executives and entrepreneurs in the audience. So don't be anchored to any particular valuation. Oh, my friend raised money, a year ago at X, or X times revenue, or my friend raised money last week at X or X times revenue. That may have changed, and it may be completely different in your particular segment or subsegment of the industry. So get multiple bids, take the highest bid, just like you would in a house. Don't really be anchored to any particular valuation metric. Anyway, so this is a question I do want to hear from Dana and Tom, and I'll start with Dana. Have you seen the actual terms change for early stage companies?
I would say we haven't actually seen a ton of change in terms of things like liquidation preferences. There was a lot of talk about that. And liquidation preferences are a way of, since we're defining terms, just providing a mechanism in investment documents to help investors get more of their money back faster, essentially. So, a lot of talk about 2x liquidation preferences and things like that. That's not something that we've really been seeing. And I don't know if others have. I'd be curious to hear. But we've definitely seen valuations coming down. And to me, I think that's a good thing. It's a good thing for us from an investment perspective. We end up with better deals. But honestly, I think it's actually a good thing for you all from an entrepreneurial perspective as well. One of the biggest mistakes that I would say I've seen entrepreneurs make, and I'm wearing my incubator hat here, is trying for the highest possible valuation that they think they should get. Some of that leads to that anchoring problem where if you've anchored too high, if you've anchored way too high, an investor is probably not even going to engage in the conversation with you because you're not within the realm of what they perceive or what we perceive as reality. But we've also seen a number of cases over the last couple of years where companies that have raised at too high a valuation now have to go out and raise rounds at a lower valuation than their last round. That's really bad for you from a dilution perspective. So I think there's a lot to be said for actually right-sizing the valuations, and that's what we're really seeing happening.
Yeah, Tom, how about you? Have you seen terms change either a little or a lot over the last 18 months?
So valuations for sure, and I think they'll continue to compress in the months ahead and probably beyond the summer, is my belief. We haven't seen wild swings in liquidation preferences. We're not, we're not seeing a 2x. We're not seeing anything that is too aggressive like that. It's within reason. I know, more subtle mechanisms. If we do, sometimes we'll invest using notes. Often we'll use safes. We've seen safes proliferate over the last couple of years. But we won't do a safe unless we are able to work in a most favored nation clause, which gives us the opportunity to, throughout the life of that outstanding safe, to adopt more more conducive terms if offered to an investor. We won't do a deal without that. We won't do a deal without a cap at close that provides us a ceiling on the valuation. And sometimes you get a little pushback, and we don't see the pushback anymore. So things like that.
Yep.
Yeah, great. So jumping around here, Ben, a lot of people talk about IPO as a great exit opportunity for a company. Can you talk about how realistic that is and whether companies should be focused their time and energy on the goal of an initial public offering for their exit?
Can everyone hear me? Yeah. Several problems.
Yeah.
That's an interesting question. I just had this long conversation with some Wall Street people last week, and they were talking about some of the market fluctuations making it somewhat harder to IPO than that to continue for the rest of the year. What I'm seeing much more of is a consolidation, and I think it's helpful for founders to start looking at what would be that exit? Where would you, is Cisco the right place where you might find a buyout?
Right. Strategic combination.
Strategic.
Yeah.
Right.
Yeah. So let's jump back to fundraising. Let's say, there's an assumption on my part, and again, I've been doing this for 23 years now. You come in and say we're growing 500% a year in revenue, and you almost don't have to address, the rest of the topic because obviously you have product market fit and you're good at communicating that to your potential customers. But let's say you have no revenue, and I'll start with Tom. But let's say you have no revenue. What are the most impressive things you can hear from founding and executive teams where the revenue conversation is going to be, we have none of it? What are you immediately jumping to for your top 1 or 2, 3 other attributes that an entrepreneur should be, extremely prepared to wax eloquently about?
So again, if we're looking at it from a purely tech lens versus in the life sciences,
sure. Let's talk about tech.
Revenue. You're really looking for good science. You're looking for protected positions. But if we're looking at tech, and we're looking for proxies for that product market fit. We're looking at evidence of having an understanding of the market problem. This is the way we look at it anyway. We like to see people who have lived with that problem in one capacity or another. We like to see people who have gathered data and evidence, have maybe done, used a lean approach toward building with repetitive, testing with that marketplace.
So Tom, this is kind of like drilling for oil, that if you see oil seeping up at the surface, there might be a giant pool of it down, 1,000 feet.
It might be, or you might have to drill a few more wells.
Yeah.
But
But it's a good sign.
We certainly look for that proxy, and we look for good teams, people that, that's a whole other question of what we look for in people, but we look for people that have the flexibility and the self-awareness to move within the market to gather the right teams around them.
Yeah, so let's say,
Go ahead.
Yeah.
founders that know what they don't know, right? And know what they need.
So maybe that's modesty.
Maybe it's a little modest,
Yeah.
but it's also just an understanding, right, of what they need.
So it's realism.
Realism. A good plan, especially if they're pre-seed. I like to see companies that have a POC going, that their tech is tied and they have an avenue to go, and that they know where they planted the flag. They know exactly the steps that they're going to take to get that revenue. Right?
Yep. Yep, so
Very
that they've got a
important
plan.
to focus on that when you're talking to people.
Right, so modesty, realism, and having an actual plan, right? So you don't have any revenue, maybe you think, time is not so important because I don't have any revenue. Well, it is. We still want to see what is the plan for every month or quarter or week for the next 52 weeks. What is the plan? And then I can measure your progress towards that plan, because I'm never going to write you the check in the first meeting. So this is a little bit of cheat that investors use is, yeah, just tell me what you're going to do next week, and we'll talk in 2 weeks, and I'll see if you did it. So don't.
I'll give you an example of what not to do. I was talking to a company today, and I was asking about this exact thing, their use of funds. And the CRO turned to me in a Zoom call and said, don't worry, we've deferred all of our revenue. And so I turned to the CEO and I said, what's the sum total of that? He said, I don't know, but I'll get back to you.
Yeah.
So this is a company who is asking for a $3 million raise, and they had $3.2 million in deferred payroll.
I bet they defer your return too.
Yeah, exactly. Yeah, no, I mean, if you know anything about net present value calculating, things today are worth way, way more than things tomorrow. So Dana, since this is such an important topic, company doesn't have revenue, what are the 1, 2, or 3 most important things a pitcher, whether it's the founder, the CEO, or the CFO, can do to impress you, catch your attention, and get you to engage with them?
Yeah, and we are frequently investing in companies that are pre-revenue. We invest in seed companies. We frequently invest in pre-seed companies, both through the angel network and the fund, and sometimes in life sciences. So it's not uncommon for us to be investing before there's revenue. And we can get back to team and sort of what we look for in individuals. But Tom mentioned proxies. A relatively good proxy for revenue is an LOI. Right, you can get a letter of intent from somebody who is a defined customer. It's not necessarily a commitment. Ideally, it would be a commitment. But if you can get multiple letters from people who are your exact target customer saying, I recognize this product isn't quite ready yet, but as soon as it is, I have set aside budget to buy this thing, that is a really solid proxy for revenue before you're generating revenue. The other thing that Ben mentioned, having a proof of concept. One of the things that we see a lot, with the exception of life sciences and kind of deep tech, it's gotten super cheap and easy to start most companies. And I realize that's maybe overstating it a little bit, but there are lots of ways that you can toss together a proof of concept that don't have to be a fully blown out tech stack. Unless you're developing a hardware device, so different use cases. But if you're developing something that's a SaaS platform and you want to show that you have users who are interested in using it, pull something together with Google Docs. You can use masking tape. You can use chewing gum. It doesn't have to be pretty. If you can get a minimum viable product out there, get people using it, ideally get people paying for it, but if they're not paying for it, using it, talking about how they will pay for it, using it repeatedly, not just signing up for it and then never using it again. So there are lots of ways that you can show proxies for traction without necessarily generating the revenue that both you and we would like to see.
Great. So I collected the audience questions out in the lobby, so I apologize if I didn't speak with you. But here's one for Tom. An entrepreneur asked, I want to ideally, I think I've figured out that I want to attract some investment from luminaries in my industry, people who've had experience. But does it matter tremendously how much they invest? Meaning 10,000 versus 50,000 versus 500,000. Is it still valuable to get someone who's a credible, let's say, expert in my industry with exit experience, even if they're only going to put in $10,000 or $20,000? I'm wondering, Tom, what you think about that.
Yeah, well, interesting question, Randy. I guess I wonder what the commitment to the company is. And if there's evidence of commitment as a long-term advisor, just don't care about the check size or if they are glued to the company, if they will act on behalf of the engaged advisor.
Yeah, I mean, for starters, this person is willing to admit that they know you. And then even further, right, I mean, they're not just linked to you on LinkedIn, they're literally taking their after-tax savings and forking it over to your company at a very early stage. So I can tell you from my point of view, you know, 10,000, 20,000, it's all way more impressive than zero. And, you know, way more impressive than for you to say, oh, you know, I know the founder of Netflix. Yeah, no, that's good, but what has he done for you? Well, he made some intros. Again, that's okay, but if he gave us $25,000, I'm assuming you had quite an involved conversation before that happened, and it's just generally impressive, and that's going to lead to further conversation.
I would say I like to see advisors that fill key roles that you need in your evolution, right? Whether it's an exit's a good one.
Right.
But there are others along the way, someone that can get you distribution if that's what you need indirectly, or customers if you want to go direct. Just a different piece.
Yeah, so what Ben's getting at here is you don't have to do this yourself. And it's way more impressive if you, A, know that, and then B, you've gone out and you've roped other people into this journey that you're on. So don't think that you have to do it all yourself. Don't even think you've got to do the pitch all by yourself. I mean, bring your friends, advisors, employees into the meeting and say, Jim's in charge of sales and Sally's in charge of technology, and you know, Jim's one of our advisors and he has 16 exits in the same business. We don't expect you to be a hero. And if you're going to have, you know, 100 or 1,000 employees at some point, you might as well start as soon as possible and show us that you know how to manage those different relationships, right? Some are advisors, some work for you, some may be peers, some are on the board. Show us that you can be the center of that ecosystem as opposed to the, you know, the master of that ecosystem.
I would take that from the other side. I would if you are the hero.
Yeah,
present yourself as the hero.
That's dangerous, right? What if you know, get in a car wreck or something? I mean, we don't want to see the whole company, you know, dissolve just because you might get sick or something like that.
Three thoughts. One is your main job as founder CEO is sales. It's sales of a variety of different types. It is product sales, but it's also selling your vision. It's selling your vision and it's selling the company and its potential to investors. If you're able to sell your vision to somebody who is a luminary in your field, that is a big mark of approval. Additional ways that you can leverage people who are luminaries in your field or who have the other skill sets that you need that you recognize that you don't have. One is, even if they're writing small checks or if they're on the advisory board, when we're doing diligence, we're going to want to talk to them. So they should be people who are going to be willing to talk to us as investors and who are going to sing your praises, who are going to sing your praises in a real way, because we'll see through it if they're not, but who are going to be able to talk about why they're bought into your vision. And then the third piece, for those folks, they should be able to open doors for you. They should be able to open doors to customers. They should be able to open doors to other advisors. They should ideally be able to open doors to other people who will write checks. So if somebody's coming in and saying, hey, I really believe in what you're doing. I love it. I have phenomenal experience. I'll hop on a call with you once a month. I can only write a $10,000 check here, or I can't even write a check here. But you know what I'm going to do? When you need a reference, I'm going to be that reference. You know, I know 3 people who might be a good fit for this. I'm going to make introductions for you. So, you know, both that's something that we'd be looking for from an investor perspective, but also you are in an empowered position when you're talking with people who believe in your vision to ask them to help you in those ways.
That's great. Ben, here's another question from the audience. Are fundraising platforms such as AngelList or Start Engine a viable alternative to venture capital funding?
That's an interesting question. I would say AngelList is probably a good place to start. I think really it's a multi-pronged process. I would try to do it in as many ways as you possibly can.
Right. Yeah, no, that's good advice.
Piece of that puzzle.
Yep. Tom, what do you think of platforms?
Yeah, I think there's utility in them. So we ran our front end on Gust for a handful of years. We switched over to a proprietary platform. We still maintain a profile on Gust because people go there. So, you know, you never know what people are looking at. I think these platforms are valuable. But you have to take a multi-product approach to it.
Yeah, so here's another question from the audience. I'll pose it to Dana. Is it more important to be in a particular industry that funds are focused on, or is it more important to have great KPIs or key performance indicators? So, essentially, is it better to be in data science versus, e-commerce or cybersecurity versus having other operational performance metrics?
I guess my first answer to that question is you should be in whatever industry you have expertise in where you think you can build a great business. So trying to build a business to try to chase funds, I think typically doesn't work that well. There are people who will write checks into anything, right? There are people who have expertise in everything. There are people who have passion for everything. So I guess where I would land on that is that the KPIs are much more important. If you have a business that is ideally generating some revenue, if you have a clear pathway to profitability, and then you have a pathway from there to extensive growth, you have some possibility of an exit, you'll ultimately find investors who are interested in a great business regardless of what the industry is.
Yeah, so Dana's saying there, just be yourself. And this goes back to the realism, the modesty, the honesty, and again, be yourself. Don't try to be, I know I said speak our language, but don't try to be something you're not, because we're going to see right through that. And if we don't see through it in the meeting, we're just going to make one phone call and they're going to go, really? They told you they know how to code? I don't think so. They were making that up. So yeah, just be yourself, because you're always going to do much better. Yeah.
Exactly. Just be saying, just be yourself. We see hundreds, thousands of people just like you. We want to see who you are. We want to see that you have the right plan and the right vision, not that you're going to try to pretend to be someone else or use terms that you don't understand.
Yeah, and related to this, don't really argue with us, because if we tell you we see a certain, characteristic or even an outcome like, yeah, that doesn't sound like you're going to win that contract, don't really try to argue with us. Instead, think of it as a teaching moment and say, why does that guy who's heard thousands of pitches think what I described was a contract we're not going to win? Let me go back to my sales team and go, Randy said we're not going to win that contract. Don't really try to argue and go, no, he said next week. Because all we got to do is wait 2 weeks and we'll see who's right. So,
kind of sounds right what we've seen in the movie before.
Yeah, we've seen thousands. So again, don't argue with me. Just let's wait 2 weeks and see what happens. And again, in the meantime, go back to your sales team. Tom, here's a question for you. What kind of investors should pre-code companies have, if there's any profile at all for pre-code company investors?
So, in the time-honored tradition of Washington discourse, I'm going to answer the question that I wish I'd been asked.
Yeah, okay. There you go. Teaching moment for me. I should have asked a different question, Tom. There we go.
That last point.
Okay.
I don't mind somebody standing around to me.
All right, put 30 seconds on the clock for Tom. Add 30 seconds,
I'm
yeah.
very comfortable with that. I think, to me, if I consider a self-aware person, it's someone that knows their strengths, knows what they know, and knows what they don't know, and is willing to concede, but is also willing to stand their ground. I will do my best. I think that a big part of, I don't know if my microphone's working. Is it on? So I think we touched on self-awareness among founders earlier, and I think for me a big part of that is knowing what you know and knowing what you don't know, knowing what you're good at, being willing to fill in the gaps with other people, to take advice, but also to be able to stand your ground. And when we make an investment in the company, we are investing in people because fundamentally we believe they've got their hands on it. They know it better than we do. And I guess I ascribe to the school that you probably know, unless you're talking to someone who has deep sophistication in your space, you probably know more than most of the investors you talk to. So we tend to lean into the entrepreneurial bit that way. So a little bit of a contrarian view, perhaps. Now, what was the other question I was supposed to answer?
Yeah. Is there a specific profile or any characteristics at all of the ideal investor in a pre-code company? And for people who don't know what that is, it means you don't have a minimally viable product at all. You were still writing the code, or possibly you haven't written any of the code.
You have a napkin.
Yeah, which is absolutely fine. Every company has started with a napkin or a proxy thereof.
The proverbial napkin.
Yeah,
So
yeah.
the characteristics of an investor in such a company, well, self-confidence would be one.
Yeah.
No, but somebody that knows the space, has some familiarity with what you are doing, that can suspend disbelief where others may not, that you're on to something
with regard.
Tom, let me just interrupt you there and tell this teeny little anecdote. I talked to a company, and they told me they had the former CEO of Citigroup as one of their investors, and that I could talk to him. So I look it up online. That's the guy, former CEO of Citigroup, like 30 years ago or something. And I call the guy, and, he says, yeah, I'm out in Aspen in my ski house. And I said, basically, how well do you know this guy? And he said, not that well. And I said, how well do you know this industry? And he said, not that well. Frankly, I have so much money, I was just throwing it around, and I figured I could give this guy a couple $100,000. So, of course, I said, how's Aspen? I was done. I mean, there was nothing else to really talk about. So I'm saying it's way more important that you have someone who knows a lot about your industry and just can give you their time, can give you their name, can give you even, $800 to help you accomplish the goals you want, than to get just a name or kind of the biggest star you can possibly find. So here's another question that, again, these are really good questions. You guys are obviously a very smart group of entrepreneurs, and I'll pose it to Dana. Should entrepreneurs care at all? And of course, there's not much they can do about it once they're about to make a pitch. But how secure or insecure should entrepreneurs be about their level of education? Either the level they've attained or the quality of the institutions they've attained it from? From the investor point of view, do we care, really, is the question. How much do we care about that?
I'll give you the ideal answer, and then I'll give you the, I think, slightly more real answer. In the ideal, it shouldn't matter at all, right? If you are the right person with the right idea, it doesn't matter if you went to school, it doesn't matter where you went to school. That's really not what we're looking for, not what we should be looking for. I will say, however, that brands tend to be taken as a proxy for success. So, when you're putting together your pitch deck, if you have a slide with your team, if you have good logos that you can put on that slide, it doesn't have to be education. It could be, you worked for a company that people are going to recognize. It could be that you have advisors who worked for a company that people are going to recognize. I would love to say that investors don't care about any of that. But part of what we're looking for is signal that you're attracting the right resources to be able to be successful. Education is not really a factor there, but in the absence of other clear evidence, things that we can recognize as something that was successful in a similar space or something that would otherwise position you to be successful in that space.
I would say that I don't really care where you went to school, unless, for instance, you are pitching a company about total homomorphic encryption, and nobody on your team went to MIT or whatever school that's required, or didn't work for the NSA. That's a little bit of a red flag. But in general, if you know your space and you're passionate about it and you know the pathway,
Yeah, good. So we're going to start to wrap up now, and the question I'm going to pose to all the panelists, for a change here, is just what one or two bits of advice you could give to the entrepreneurs in the room who are trying to pitch people. And I'll start off by saying, just dummy down your pitch. A lot of people throw in a ton of buzzwords, world-class team, things like that. Just keep it simple. Be specific, but if you've heard of SMART goals, specific, measurable, attainable, and time-sensitive, and realistic, just tell me those things in plain English. I don't need to hear a bunch of mumbo-jumbo where I need to stop you every 30 seconds and go, what was that? What is holistic? What does that mean? What does world-class mean in the context of your company? So just make it as simple as possible, and we'll have a much more productive meeting. Ben?
I would say know your pathway, know your pitch, and anticipate what people are going to say. Questions that we're going to have, like, what's your exit? If we say, what's your exit, and you say, I haven't really thought about it, that's not going to fly. Or, how are you going to use the funds? Oh, well.
Right.
Or you're in a piece of software that we know requires a lot of R&D to keep up, okay? And you don't, none of the use of funds is for that. You better know your space.
Yep. Dana? What one or two pieces of solid gold advice?
The job of your pitch is to get the next conversation. It's not about getting a check. It pretty much never happens. So you don't need to tell us everything about your company or everything about your product in a first pitch. You need to tell us enough that it sparks our interest, sparks our imagination, and gets us to want to dig in further. And then the other bit of advice, since we started off talking about sexiness, I'll go into a very quick dating metaphor. You are getting into a long-term relationship with investors. This is not something where you're like, hey, write me a check and then that's it. If we write you a check, we are in frequent contact with you for the next 7 years, sometimes 5 years, sometimes 10 years, sometimes more. Dating is super important. You are developing a long-term relationship. It's part of what we're doing in evaluating you is, do we want to be in a long-term relationship with this entrepreneur? It's equally important for you to do that, to evaluate your investors and see if you want to be in that long-term relationship.
If you date with somebody and all they do is talk at you and don't recognize when you don't want to hear it,
Yeah.
you can imagine that what we hear.
Let me expand on something Dana said here. So in addition to the pitch being succinct and relatively short, don't bury the lead, if you've heard that term before. So if you pitch me for 10 minutes and, like on Shark Tank, I go, I'm done, I'm out, which of course I would never be that rude to you, but I made 2 now, right? You see me checking my emails in 10 minutes. Don't go, no, Randy, in another 10 minutes, I'm going to get to the really good part about how we signed up Microsoft. Why are you doing that? Tell me that first. I go, we just signed up Microsoft, and now I'm going to tell you why they bought. Oh, okay, well, now I'm really engaged. So a lot of people I see, they make it way too long and involved, and then again, they bury the lead. They get to the really good stuff. Did I tell you my founder, co-founded Netflix? No, why didn't you tell me that in the beginning?
You know what I like? I like when I get a person on the phone or on a call or a video call, and they ask me, what do you expect out of this? What do you want to hear first?
Yep.
Yeah, exactly.
Great sign. I'm already interested.
Yeah, Tom, 1 or 2, pieces of solid gold advice for the entrepreneurs in the
Sure,
room.
take time to build a
Mr. Solid Gold
Take time to build the
from
relationship.
Midas.
Take time to build the relationship. People take a long time diligencing you. Take a long time to diligence them. Get to know them before you're down to your last dime and you're desperate for capital. Secondly, going back to Randy's point, raise your hand if you like to feel stupid.
Yeah.
Nobody raised their hand, right? So you've got to know the audience. You've got to be able to gauge where they are coming from, express what you know very well in terms that are adjusted for whatever audience, whatever partner in a firm you are facing. So you've got to know that, and you've got to be prepared for that. Finally, be able to pivot within the conversation, be flexible. There's nothing for me more impressive or important than being able to respond to Q&A. Even if you don't get the pitch quite right, if you can respond to the questions in a meaningful way, I find that very helpful.
Great. Well, we're going to have to wrap up here, but I'm going to conclude with something Dana said in response to my first question is, we're trying to make money here. So everything you're pitching us is around that theme. You're telling me a story of how you're going to make money for not just me, but yourself and all your investors. And you're kind of filling in the blanks. We sell this product to these people or this kind of company, but the whole story ends with, and then we made a ton of money in terms of capital gains, not interest, not, dividends, not other things, but the long-term capital gains, because it's going to take more than a year, are going to be voluminous. That's the story we have to tell, and everything else is just kind of an adjunct to that or supporting evidence. And we should be kind of nodding up and down the whole time going, yeah, no, you check that box, you check this box, that's great, that's fantastic. And again, at the end of the meeting, it's never going to be, here's the check, it's going to be, let's have another meeting. I want you to meet my partner, I want you to meet one of our advisors, I have a company that could be your customer and I want to introduce you to them. That's the outcome of every meeting, except the one where you actually do get the check. So thanks so much for being a great audience. For the people who submitted the questions, thank you, and let's have a good night. And thanks to the panelists.
Now it's time for our pitches. We have 9 awesome companies. Will the presenters please come up to the front 2 rows so that you're ready to come up on stage once you're introduced. To introduce the first four presenters, I'm going to introduce Mark Haas. Lisa Friedlander, for those of you who know her, is unfortunately sick, and so wish her well. Hopefully she can get back in action quickly. So Mark Haas, the CEO of Association for Enterprise Growth, which is the leading group of elite advisors and CEOs in Tampa, Baltimore, and here in the DC metro area. Mark is a co-founder and CEO. He's in fundraise mode also, and they're also a sponsor, so he's got a table out there with some of his colleagues and partners. But Mark, come on up and give us a little bit about AEG. He's going to do the first four companies. Thank you.
Thanks, Tien. Thanks for sticking around. So AEG is really an ecosystem of business advisors and CEOs. We're trying to change the way business services are provided and give CEOs and advisors a bigger, more trusted network of people in complementary disciplines or industries. We started in DC, we're expanding to Baltimore and in Tampa. It's an innovative business model, and we're excited to be connected to CONNECTpreneur, be a sponsor there. And with all respect to Esther Lee, she has a piece of Tien. Tien's my chair, so I got a piece of him too. I don't think there's anything left for anybody else. And I could do a lot worse than replacing Lisa Friedlander, who's an awesome attorney for Shulman Rogers. So if anybody's seen the show Dirty Jobs with Mike Rowe, he goes out and does jobs that are dirty, dangerous, risky, expensive, that nobody wants to do. Well, anybody who solves that problem is going to have a good market. So our first presenter is Fred Briggs from Applied Impact Robotics, and he's got a product that solves that problem for the oil industry.
All right, thanks for having me out here. Excited to tell you about how we're making the oil and gas industry cleaner and safer. So we're an early revenue company located in Sterling, Virginia. And the problem we're working on is the inspection of crude oil tanks. So crude oil tanks, if you don't know much about them, they're absolutely enormous. They're as much as 300 foot in diameter, 8 stories tall, and they're federally mandated to be internally inspected every 10 years. Problem with this is the only way to do these inspections currently is to send manned crews into the tank. The only way to do that is you drain the oil from the tank. That leaves about 2 feet worth of sludge and sediment. So it's about 5 football fields worth of toxic sludge and sediment that has to be manually evacuated from the tank. That process, it's dangerous. You have to send crews in there in order to evacuate that. It releases tons of VOCs into the atmosphere, and then all that toxic sludge has to be environmentally remediated. So the solution for this is we actually inject a robot into the side of the tank and automate the entire process. We actually are able to do this while the tank remains in service and keeps all of the sludge and sediment in the tank. So we actually have a patented technology that's able to reduce the viscosity of the sludge and sediment and have the robot maneuver directly in the sludge and sediment to deliver sensors and do the integrity inspections. This eliminates all of the environmental problems as well as the dirty, dangerous work. So this is an $18 billion market. There's about 45,000 of these tanks in service around the world. They're inspected typically about every 10 years, so about 4,500 of these done annually, and it costs about $4 million in order to do one of these inspections, mostly because of all that toxic sludge that needs to be removed. So we do have competition. 100% of the competition requires the tanks to be taken offline and send in man crews in order to do this. We are the only company that's been able to demonstrate an ability to keep the tank in service, reduce the carbon footprint, eliminate those 2,000 hours of confined space entry, and keep the tank in service during inspection. So we have fantastic partners. We have public partnerships announcements with both BP and Chevron on this. We have 10 commitments for field testing, 27 customers engaged, and we're in the early revenue stage. We should receive about $500,000 this year, and we have for our first pilot programs, which will be in Q3 of this year. We have a fantastic team with 57 combined years in the energy field, $1.6 billion in acquisitions, and over $1 billion in exits. In terms of how we're going to deliver this, it'll be a robot as a service. We'll be delivering service directly to companies like BP and Chevron. The expectation is to do $2 million in revenue per inspection. Because we're not removing any of that sludge or sediment, we're actually able to eliminate nearly all of our costs. It only costs us about $200,000 in order to deliver a service, giving us about $1.8 million gross margin on a service. Our target is to hit 50 inspections annually by 2027, giving us a 100 million ARR. And what's really driving this growth is the fact that we'll save customers about $7 million per inspection. So we're doing a 1.7 million raise right now. We have 1.4 million committed. We have $300,000 open. We do have Chrysalix Venture Capital as our lead on this. This is intended to get us finish our MVP, get us into pilot programs with those commitments we have with BP and Chevron, and ultimately move us into our first commercialized service. And again, those pilot programs will be in Q3 of this year. So I want to say thanks for your time and look forward to talking to you afterwards.
So a lot of the companies that present at CONNECTpreneur are about IT related or about protection, and many of those protections are ones that affect us all. Our next presenter, Ken Hall, is going to be talking about a technology that protects those who protect us, and specifically police and military and others who need to be protected from gunshots and rifles. So if we can bring Ken up, talk to you about his service and product.
Well, thank you very much for that introduction, and thank you all for being here today. Yes, I am the CEO of the Hollis Group, but I'm only doing this for one reason. It's because I care. I'm compelled to save lives. And I'm hoping that you will catch fire and also join us on this journey. Today I intend to show you two incredible opportunities with huge potential and very limited downside. I will focus on Armor Research Company, and my associate will focus on Armor Mineral Company. Both are associated, both use the same basis of material. Okay, I'm sorry. Let me get us to the right point here. Allow me to introduce Armor Research Company. It is a revenue-generating enterprise that has experienced remarkable growth in a very short period. The initial sales for the first year, which was in 2021, was $335,000. Last year, we hit a 300% growth margin from those sales. So far this year, we matched last year's sales in the first quarter, and we are currently on a trajectory to reach over 500% sales. Our gross margins exceed 45%, and our cost of goods sold are less than 25%. Our focus is directly and impacts school shootings, troop safety, and effective policing. These are all critical issues at this moment. How do we mitigate school shootings and mass shootings, the market that's out there right now? Well, we can't address some of the things that are preliminary, some of the things that cause it. We don't have that access at this point. Schools are trying to reform how they deal with things. But the truth is, the only mitigating factor is how fast we get to the point of impact. How can we reduce the time that the perpetrator has to cause trouble, to take life? Now let's talk about the company goals. The Hollis Group is committed to saving lives, serving the public trust, supporting national interests by tackling critical supply chain issues. We believe that leveraging these issues provides the greatest return to our investors while being socially responsible and financially a secure investment. It is extremely important that we take care of our officers and our military. The current ballistic protection that exists does not do the job it was designed to do. It is typically too heavy, monolithic, ill-fitting, and it's prone to fractures. These issues cause secondary trauma to the people that are using them. As a matter of fact, Congress just passed the Female Body Armor Modernization Act last year. It is currently unfulfilled by any vendor, including the military. Our product fulfills that in its current form. We have the only articulating, flexible, rifle-defeating armor that is on the market today. I want to just touch base real quickly on the fact that we have taken this challenge to change the market and to address the critical needs of the market and the minerals that this country desires. We also want to regenerate our manufacturing prowess in the United States. If you are moved to partner with us and help us to save lives and address other solutions and mitigate school shootings, all the things that go with it, I ask you to come to our table afterwards and I would be glad to explain all the details. Thank you very much.
So a little closer to home, our next presenter will be talking about something that we all have familiar with. It's not about body armor, it's about helping us, those of us who have injuries, medical injuries, who have therapies, and it's a way to actually provide data transfer of therapeutic interventions and the ability to just be on top of it, provide faster relief, more connections to your doctor, and faster recovery. Welcome Chris Castle, founder and CEO of CareWare.
Thank you. Okay, so we're going to talk about CareWare, wearable therapeutics, and I won't bother with the disclaimer, but we have key investment highlights. First of all, we're first to market with a wearable photobiomodulation delivery system. And this is used in the treatment of pain, arthritis, soft tissue injury, and particularly when we're dealing with inflammation and really tissue regeneration. Now, you've probably all heard about, red light therapy and things of that sort, but we've developed a really unique delivery system that makes sure that we get the correct dosage all of the time, that we can monitor that correct dosage remotely and allow this to be integrated as a home therapy for patients to use within their rehabilitation program. It's scalable. We're working with a couple of major companies that are involved from my previous business, which we sold to Hanger for $160 million. We built a company that was $75 million in the space of long-term care, assisted living, and a number of different areas of the industry. And so now we're using that same group and the same team that had done this before to actually build this out in a way that we take these types of therapies to the home. And imagine trying to do a telehealth visit or telling a patient to do exercises at home when they hurt. It's not easy to do. You can't get out of the chair, you can't move, you just had surgery, so what do you do? So you have 100 million people a year that have this problem, so it's not a small issue. You've got 2 million people that are being treated by large enterprise providers in the therapy business. These are my prior customers, okay? They're people that we have deep relationships with. And we figure about 600,000 of their patients are eligible. And these are providers, by the way, with 1,000, 2,000, 3,000 therapists working for them. As we continue here, hold on, there we go. As you can see, and by the way, we're exhibiting this over here so you can come and see this, but we have a really cool system that, provides light and therapy, but it also ties in really well with telehealth and digital health, and it's now also reimbursed under Medicare reimbursement for remote therapeutic monitoring. So what we see is, for example, in soft tissue injury, contusion, and so on, we use pulse blue and red light for this. It's quite effective. We've published extensively in this area. We have a robust wearable device that can be used both within a digital environment. It's fully mobile. You put it on your body, you walk around. It's innocuous relative to the user and quite effective. So we have IP, 55 patents right now that are issued in 10 different families on a global basis. We have approval by FDA, CE, Class 2A medical device, Health Canada and Australia, and as I mentioned, it's covered by CPT codes under Medicare Part B, about $150 per month per patient. The competitive landscape shows our safety, efficacy, and ease of use, and I'm not going to go through that in detail now, but we can talk about it as the night progresses. We have a really terrific team that's done this before. I have a PhD in physical medicine and rehab, but we've been in this industry for a long time. We have a great board and an institutional investor in the St. Baker Energy Innovation Fund, and we've invested approximately $14 million into this project to date. As I mentioned, it's scalable. We have about growth. We have revenue right now, but we focused on the pro sports market to start with, but we see very fast scaling at an enterprise level. Lastly, we did, as I said, $13.5 million to date. We are doing a bridge convertible at a 20% discount to our A round. We're represented by Alira Health in that, and we are approximately right now at about two-thirds fulfilled on the $2 million bridge, and we also have a significant strategic issue on our Series A. So we look forward to chatting with you in more detail over this evening, and really appreciate the opportunity to visit with you today. So thank you very much. And I might add that we've got one of our medical directors here tonight, Dr. Terry Baker, and he's also going to be at the meeting, and we look forward to chatting with that. Thank you.
So our next presenter, if you think about how cancer used to be treated, it was pretty brutal. Radiation, chemotherapy, that kind of just destroyed everything, just had to kill everything. And that's the way a lot of IT solutions are. Lock everything down. Lock the doors, lock the windows, make sure everything's protected, but it's not a really good way to live. And for a business, that's not a very convenient way to improve your profitability and efficiency. It's not a very good business model. So Professor Heacock here is going to provide some information here on deep terrain, on how he's going to solve that problem with a little more efficacy and a little more profitability for companies.
Good evening, everyone. Hi, my name is Ralph Heacock. I'm the founder and CEO of Deep Terrain. We take our name from deep learning, the cornerstone of AI, and applying it to a company's cyber terrain. We are an AI-driven, pre-breach, proactive cyber resilience software company. What we're doing is creating an approach that is so bleeding edge and groundbreaking that Gartner has not yet created a magic quadrant for what we're building. We are radically changing how businesses prevent and withstand disruption from cybersecurity events. And we're here today hoping that you all will join us on our journey to make businesses impervious from cyber risk. So if you think about it, today cybersecurity should be about protecting the business, but what we find is that it's instead about protecting all IT assets. Most companies today are trying to lock down all of their IT without understanding which assets are crucial to the business and therefore merit greater protection and attention. We fix that. We help companies understand and prioritize their digitally dependent business functions, the things that must happen every day for them to make money. Our technology, called Terrain AI, begins by mapping the connections between a company's business processes and the IT to create their digital twin. Terrain AI then drills down into those relationships between the business processes, the data, and the IT that they rely on. And unless you understand those relationships, you can never be truly cyber resilient. Our AI provides a unique understanding of these relationships, and the results are unprecedented, allowing us to pinpoint and protect critical IT assets and to forecast disruption from a cyber attack. This creates a universe of opportunity for automated cyber resilience, ensuring that businesses can continue operating without disruption and showing what failure to do so will cost. One key example is Colonial Pipeline. Battery just broke. I will just, can you change the slides or we'll just go? Okay, here we go. One example is Colonial Pipeline. This cyber attack happened here on the East Coast when we didn't have access to gasoline for about 10 days. What most people don't understand, though, is that that cyber attack wasn't on the pipeline itself, but on the payment system. Colonial didn't understand that without a functioning secured payment system, they wouldn't pump gas. Terrain AI would have helped them understand that relationship, saving them millions in lost income and continuing to provide a critical service to the American people. Just like Colonial Pipeline, most businesses don't understand that they have processes in place that require IT to run, and those specific assets need to be prioritized for protection. All of their IT assets look the same to them. Deep Terrain, though, through the prism of business impact, clarifies what is critical and what needs to be secured first. To understand those relationships, you have to get senior executives, business managers, and the IT team on the same page, and we're the Rosetta Stone that provides that conversation. Everyone knows that cybersecurity obviously is a very valuable market. I've just shared a lot about our unique approach. Now I'll share a little bit about how we have a lot of traction and opportunity in our market. There is already a huge demand for cyber risk assessments, and right now our point-in-time risk assessment allows us to be extremely competitive in this market. However, the next iteration of our product will be a software as a service model that will allow us to proactively defend businesses and their key processes based upon the changing cyber risk landscape. We are currently working on a $1.5 million raise for our seed round. The MVP is complete, but we need money to finalize our commercially viable product so that we could take that to our charter customers and channel partners that we have lined up. We already have letters of intent from several of them, and they're waiting on us. We're going to use the $1.5 million to become an industry leader in AI-driven proactive resilience to keep our clients ahead of tomorrow's cyber threats. We are pre-breach. We are left of boom. We are the root of real resilience. We are Deep Terrain. We look forward to having a great discussion with you this evening, and I want to thank you all for your time tonight.
Now I'd like to introduce our friends from Forvis, who will introduce our next 5 presenters. Leading off, I'd like to bring up Ling Zhang, who's a new partner at Forvis. Forvis is a top 10 professional services firm nationally. They have offices all over the country, and they are a phenomenal company. They're working with some of our companies, and they're doing a great job, and they do accounting, tax, advisory work. So Ling, come on up and say a few words about the company. Sure. Thanks.
I'm trying to scan for my old friends and also new friends I met today. Thank you, Tian, for having us today. My name is Ling, partner with Forvis. I felt Tian did everything, the talk for me. So definitely, I'm very excited here to introduce Forvis. Let me ask a question. Before Tian introduced Forvis, how many of you heard our name, Forvis? Thank you. Thank you very much. So Forvis, let's actually have my fantastic team stand up, and in case you guys want to talk to them after this meeting, Forvis team, please stand up. Thank you very much. Forvis is a top 10 U.S. accounting firm. If you haven't heard the name, it's not strange, because we were created by an equal merger between DHG and BKD effective June 1st, 2022, which new brand is only a year old. But our legacy firms has over 100 years of history to provide, going forward as well, our forward vision for this, to provide unmatched client experience to you and our new future clients. Thank you very much. And I would like to hand it over to my partner, Will Choi, who is the industry leader of the firm for technology and the software.
Thank you, Ling. Okay. So our next presenter is co-founder and CEO Dan Cohen of PaintScript. So PaintScript has developed a SaaS platform to improve patient care plan adherence and medication compliance.
Thank you, Will. Dan, thank you so much for having us here tonight. One of the biggest challenges in healthcare, especially for chronic patients, is that patients just don't follow doctors' orders. They can't seem to take their medicine. They can't seem to follow directions to regain their health as prescribed. And this costs the entire healthcare system, you and me, $600 billion a year. And now insurers, not your doctor, decide how much healthcare you get. These changes continue the lowering of physician and staff productivity and significantly increases non-billable work, a problem that needs repair and, more importantly, modernization. The PaintScript approach fixes these problems. Our physician-centric platform is a game changer for chronic care management, both for the practice and for the patient. Our SaaS platform automates existing processes, reduces costs, and drives new revenue. Our process works, has been demonstrated in 10 peer-reviewed and published clinical trials, including one very recent patient observational trial of efficacy, all establishing that our approach improves outcomes. Automation is a key attribute. Our platform improves office workflows, increases functionality, and is designed, holy cow, how does this thing? We love technology when it works. Our platform improves workflows, increases functionality, and is designed to make practices more efficient, all to capture current practice time on patient treatment and gain additional billable benefits. We solve these clinical, operational, and financial challenges via our proprietary app. Between 85% and 92% of patients respond to their physician every day, ensuring constant monitoring and proactive healthcare alerts. All aspects of the platform are fully customizable, including workflows and medication guidelines, improving compliance and working with existing AMA CPT codes for telehealth. We link to the practice electronic medical record, and all this functionality comes via a simple smartphone-based application. Chronic management is a major healthcare issue, and there are others that are trying to tackle this problem. As this patient-generated observational trial demonstrates, our solution is different. It works. And simply put, our clients love our product. Within the huge market opportunity for chronic care, we have initially prioritized pain management and substance use disorders. And with the funding we seek today, we will launch into the largest, fastest-growing market in America, obesity. Our platform works for any chronic disease state without needing any costly additional development. We have completed our beta commercial launch and already have practices on our platform following over 600 patients. Added practice growth, scale, and vertical development will be our primary use of funds. Our team is amazing.
and has extensive experience across every aspect of the healthcare ecosystem. And based on a recommendation from this group last year, I am especially excited by the recent addition of Jim Breedenstein to our team. Jim has led commercial operations for our SaaS competitors. His efforts have resulted in 4 exits and IPOs at a valuation in excess of $7.2 billion. In each of our verticals, we have an engaged board of nationally recognized leaders and physicians who design and review every aspect of our clinical program. Now, let's be honest. Every healthcare system solution that makes it to this stage at this point in time improves outcomes. Doctors are not looking, or not just looking, for improvements in healthcare. Now more than ever, doctors are running a business and they need revenue to survive. The PlainScript platform solves for both problems. Patients get better, doctors get paid. From inception to date, we have received investments of over $3.5 million, including several physician investors in our current round. We seek to raise an additional $5 million to build our sales, distribution, and marketing efforts, with more than 2/3 of the funds earmarked for commercial activities. In addition, just this week, we signed an agreement with one of the leading trial lawyers in the country representing physicians under DEA investigation who will mandate the use of our platform with his clients. With that, we thank you for your attention, and we look forward to meeting with you at our booth this evening.
All right, our next presenter is Vlad Lebedev, who's the CEO of Quasi Robotics. So Quasi Robotics is a platform that integrates powerful robot-agnostic quasi-AI algorithms. Wow, that's a mouthful. Robust R2 hardware and user-friendly Cloud Connect interface to allow effortless control and decision traceability for any robotic fleet.
Again, I remember being a kid, 1980s, early 1980s, reading all the scientific novels by Isaac Asimov, Robert Heinlein, about the future. And in that future, there were those amazing machines helping humans to eliminate all boring, repetitive and dangerous tasks. Machine called robots. Fast forward in 2023, and the question is why we don't have those machines today? And the answer is very simple. Because there is no brain, there is no algorithm, there is no software to power those machines. We asked ourselves that question 5 years ago, and we spent those years developing those software, developing that brain that can power any robot out there. We've done 3 things. We developed the Quasi-AI. This is our bundle of algorithms to develop and maintain and run those machines. To test our software, we developed our own hardware. We call it R2 Robot, a true multifunctional machine. And we designed the central Cloud Connect service, where the data stream from all the machines come together to be further analyzed. And this is the place where the higher level learning and training happens. It is a big market out there. The market for the software itself, $9.2 billion. Market for the software in robotics. And the expectancy that will grow 3 times by 2026. We have 3 patents secured, 3 more in the works, and many more planned. Lots of customer interest. We have 2 companies that are ready to buy those machines. And we have key partners, especially with Intel, the company that provides our vision technology, CPUs, and the hardware. And all key relations with all key suppliers for batteries. I don't know.
Use the mic on the podium. That's better.
Right. And yeah, that's so much better.
Thank you.
Sorry guys. Well, and again, all the relations with all the key suppliers for the components. All our C-level team is professional software engineers. We spent 20 years working together. And we had 2 very successful exits in the past. There are other companies out there trying to do the same, but they are not even close. First, we are very different approach. First, we made our robots, our hardware, totally computable. So that means there is a file readable by both humans and the machine, and that file contains all the definition of the hardware. All the geometry, all the dimensions, all the joints, the friction in those joints, all the weights. We run and develop our machines in a simulator. In the last 2 years, we changed our design 4 times to improve it. And those guys, they stuck with the same thing they have it before that. Second, we made the behavior of our machines computable. There is a single file, again, that contains the behavior of the machine, and by changing that file, we can move our robot from one industry to another. We are looking and asking for $5 million. That will allow us to complete everything we have on our R&D, in our R&D pipeline, expand our AI capabilities, and prepare our company for the exit. We believe our IP and our company will be acquired by the top big tech companies. We truly believe that what we are doing for the software will change the world of robotics in the same way as Microsoft Windows changed the computer world back in the 90s. And with that, we invite you to join us in developing the future where robots and humans work together in a safer, more productive environment. Thank you.
Okay, our next presenter is Gabe Galvin from Verity, Cybersecurity Made Simple. Verity's, I guess, designed a platform to address first and third-party cyber risk for financial institutions seeking accurate, understandable, and actionable risk assessments.
Well, great to be here. So Verity is a company that we formed to make cybersecurity simple, and we do that with AI. The problem of cyber and cyber risk scoring, I think, is well known to everybody. We live in a world full of tremendous number of digital transactions going on daily. There is no quantitative cyber measurement out there that's a standard in the cyber risk area. Business operations are impacted quite a bit, and even innovation is impacted because of the issue of cyber risk and what that poses. Companies need to have a better understanding of what is the risk at hand. What we do is we produce large language modeling, AI engine, a generative AI engine to create the ever-current cybersecurity information. So in effect, we take today looking at 170 different sources of cyber laws, rules, guidelines, best practices, things across the world, and we build that into the engine. We take the customer's information, both from questionnaire and scraping information, and digitally immediately produce a cyber risk score. With that, we also design specific customized guidance for that customer. It could be for any industry, any segment, specific, bespoke guidance for the customers. So what we're in effect doing is creating, simplifying the complexity of cyber and putting it into English so that the businesses understand where they are and what they can do to both protect themselves from first-party risk and third-party risk. Over the last 9 to 12 months, we started the company a year ago. Over the last 9 to 12 months, I've talked to over 100 individuals, C-level individuals, companies across the world from all sorts of different industries. We have tremendous traction and interest by a number of them that want us to come back with our MVP. We're working for pre-seed funds to build that MVP. We have 3 companies that want to take on alpha and beta use code, use case, build proof of concepts, et cetera, ready to roll. So that's what we're wanting to do next. Our go-to-market model is really 2 sources of funding. One is through software as a service, and the other is to be provided through a service provider model. We have interest and conversation with service providers today that indeed want to do this with us. We're asking simply for $500,000. That we will use over the next 4 months to build our alpha product and close our beta by 6 months. The funding sought, we're going to use it solely for developing the code, developing the product that we need to do, putting the software development going forward quickly. The round we expect to close is the 500,000 by the end of this month is our goal. And again, in 6 months, we close the beta, and we'll go into production shortly after that. Have a very strong team, quite notable individuals that are helping us get across industries and across the world to talk to all sorts of people that are interested in the cyber risk scoring in this particular case. Our use cases, I didn't mention before, are in the banking industry specifically. We're focusing on banking as our first set of customers. We have a large bank that wants to be the alpha and the beta customer, and then we have service providers behind that as well, including a company that does risk scoring for Fortune 100 companies and is not satisfied with what's in the market in cyber today. So with that, I just want to thank you. Look forward to talking to you afterwards. Thank you for your time.
Okay, and our last presenter of the evening is Hampton Dowling of the Hallis Group. Will be presenting for Armor Mineral Company, which was established.
I'm supposed to present prior to him, just to make sure you know that I'm presenting tonight.
Okay, I thought that you weren't here, but.
Been here all day.
Okay, all right. Sono stick, right? Okay, all right. No problem. I think everyone thought that you weren't able to be located, so apologize for that. All right, so I take it you're Gary?
I am.
Okay, Gary. All right, so SonoStick, established to develop medical devices that facilitate the proper, efficient, and easy intravenous catheter placement.
Okay, well, thank you. I'm Gary Wakeford. I'm Chief Executive Officer for SonoStick. And if you don't remember anything else from this presentation, if you just remember this one statement, get it right the first time. We help clinicians get it right the first time. If you remember that and only that, you will know who we are and what we do. Now, we are focusing on the intravenous catheter market. A lot of people don't realize this, but it is the most commonly done medical procedure in the world. Over 340 million IVs placed every year in the US. And if you look at the patient sitting on the bed, the one about to get stuck, look at that look on her face. That's the person we're trying to help, and I'll show you how. I mean, she's obviously concerned there because she knows she's going to be a pincushion in the next couple of minutes. 15% of the IV patient market fall into this category that are known as divas, and it's the perfect acronym. What comes up to your mind when you think of diva? Well, in this instance, it stands for difficult intravenous access. 15% of 340 million patients, that's 50 million patients that we can help right out of the gate. But in these patients, it can take 4 or 5 or 6 sticks, and they may not even get it. It's, for the patient, every additional attempt becomes more painful. It increases their anxiety and their fear, and failure can ultimately sometimes lead to the placement of a central line, which is much more expensive and much more serious procedure. For the hospital, each additional attempt costs more time and money. Poor patient experience equates to very poor patient satisfaction scores. And if they do have to have a central line placed, when one of the major complications with an central line is CLABSI, central line associated bloodstream infection. $48,000 to treat if and when it acquires. 28,000 people die just in the US from that infection. So we can all agree that's not a good alternative. Enter SonoStick. We have a very simple guide wire introducer that will help to solve this problem, to get that access first time, every time. It literally is simple as 1, 2, 3. When they have a diva patient, they will use a portable ultrasound machine. And so imagine this, they've got the portable ultrasound machine on the patient's arm. They have our device, which has the needle and catheter over it. As soon as they advance the wire into the vessel, they literally, in the center there, you see that little track wheel. In the same hand, as soon as they get access, they just advance that track wheel, which advances the wire into the vessel. Once the wire is in the vessel, you are golden. So this is a simple, easy procedure to do that they already get. What I love about this product, when I put it in the hands of a clinician, they look at it, they just naturally start to advance that wire. So we're very strongly positioned for success. We have 5 patents issued. We have achieved FDA clearance. We have a very strong manufacturing partner in MedSource Labs in Minneapolis. They have a global footprint and contracts in place that they are adding our product to. Very strong medical advisory board of nationally and internationally known key opinion leaders, and a very strong management team with experience who have successful exits. Now, we're starting with the peripheral IV market because that's where we think we can do the most help the quickest. But this product, we've already had clinicians, even before we've released it to the market, that have seen it. They're calling us, asking us, can we make this for PICS in midlines and even central lines? Now, there's a lot of merger and acquisition activity in this market. Here's a listing of just 4 or 5 companies that could be very strong strategic partners. And I'm very happy to share that someone from BD, one of the largest IV players in the world, has already reached out to us because they're very interested in what we're doing and they want to learn more. So I'm here to raise $750,000. We are going to use this to secure initial clinical use and validation, get a handful of accounts on board, add some personnel. Right now, you're looking at the whole company. I'm the only full-time employee. And then after we get a dozen or so accounts on board, we will look to raise $10 million in a full-blown Series A round. So the train's leaving the station, and now time to get your ticket is now. Would love for you to come along.
So I'm going to introduce Hampton Dowling again. Hampton, I think this really is the last presentation for the evening. So Armor Mineral Company was established to ensure uninterruptible, secure domestic sourcing of specific critical minerals and mineral byproducts required for manufacturing some of the other HALIS products that I think we heard about earlier.
You got it right. That works.
Okay.
That works. Well, how is everybody? I mean, kind of get a little light. Jim, I have to tell you something. My boss, he's not from here, stays at the courtyard down the street and says, where am I going to go? So he asks the desk clerk, where's the Tien Wong event? The desk clerk knows where it is. He gets lost driving 2 blocks down here, gets to the crosswalk, says to the crosswalk person, where's the Tien Wong event? All the high school students and the crosswalk person says, oh, it's around the corner down the street. I don't think there's anybody who doesn't know who you are in this part of town. So it's not true bad. So pretty good. Let's all give a hand. Thanks for this evening. I appreciate that. Well, I hope I'm going to explain, I'm going to give you a problem that affects every one of you and affects your current investment. I'm going to give you a legislative solution. I'm going to tell you where our company fits into it. I'm going to tell you how we fit into it. I'm going to tell you our ask and how you can benefit from it. So in 4.5 minutes, I hope you'll follow along with me. So, but I have to figure out how to use this laptop. So how do I do this? I didn't do very well.
Use the clicker.
Oh, the clicker. Well, all right. Well, down arrow. Okay. I did a down arrow. Well, the other clicker. How many clickers are there? That clicker. I didn't get a very good handoff here. Oh, now I had animation in my program, but it's not here. I'm getting gypped out of my. Tien, I'm going to talk to you about this. We have a problem in the United States. Over 70% of the critical minerals that are required for U.S. strategic industry are all controlled, influenced, and imported from China. If that spigot shuts off, what happens to your company and your investment? What happens? It dies. And that's not a false statement. It's very true. And for the U.S. and Canada, that affects our defense industry 95%. Almost 100% of all of our defense industry is completely reliant upon critical minerals that are influenced and controlled by China. It's an amazing statistic. The vulnerabilities are far more than just national security. It involves the subject matter that's on the screen, but it's far more than that. It involves agriculture. You can't make fertilizer in the United States without critical minerals imported from China? What happens to agriculture? What happens to, where do you get milk? You get it from the supermarket. No, you get it from cows. Where do cows eat? They eat on plants on fertilizer. We are part of a solution that I want to introduce to you. If I can figure out how to do this. The U.S. government in the prior administration and the Biden administration is moving forward with government-funded, matched funding incentives for U.S. industry to pivot away from a dependence on Chinese critical minerals to produce them domestic. Domestic, up until just a couple weeks ago, included just the United States and Canada. But that's changed. It now includes, I'm sorry, wait a minute. It now includes Australia and the United Kingdom. We understand that. We've pivoted as a company to take advantage of that. And as a company, we are involved with having a partnership with a North American mining company, U.S. mining company. We have a partnership with Canada's largest mining company and mining companies in the UK and Australia. We are going to be a sole source provider for critical minerals to the Department of Defense. We are going to be a sole source or primary supplier to other federal agencies. We are going to be a reseller of critical minerals to strategic industry. We are going to be putting together and establishing a processing plant in Virginia. And we do have a joint venture partnerships in Canada. We are a joint venture partner with 3 mines in Canada. We are a $2.5 to $3 million invested partner with our Canadian partners. We are moving forward as part of a solution that takes advantage of the programs that are afforded by the U.S. government to mitigate the challenge that's provided by being dependent on Chinese critical minerals. We have a plan. We have a plan for how we're going to execute this. It's kind of an image, but those dotted lines and those dots are very important. It says that we, as a U.S. company, have a role with Canadian companies and U.S. companies to not only find critical minerals, deliver the critical minerals, process the critical minerals, and distribute them to strategic industry. We have, and right now we're looking at a 525 acre site in the Commonwealth of Virginia. This is where value comes. Investing in our company, this is where your return on invested capital comes from. All these line items. Each of these could be a M&A activity, each of them by themselves. Each of these is consequential to not only to the defense of the country and strategic industry, but to elevating and providing efficiencies to the private sector. We believe, based upon our own internal analysis, because there is no study of this, the U.S. industry is pivoting away from being dependent on Chinese critical minerals. Therefore, there has been no study. We're very used to this over decades. Looking at the U.S., North America, Canadian, Australian, and UK as the source of critical minerals, no one has done a study of this. There are no KGAR assessments. One has to step back, put on your business hat, and look at what are the potentials, which are extraordinary. This is the top line revenue that we're looking at. If you look on these pictures, this is what goes away when the spigot turns off. This is where our company is focused on providing solutions. On the right is our objectives. We want to mitigate the problem, we want to be part of the solution, and we want to provide a stability to U.S. industry. This is where the revenue on invested capital comes from, the return on your investment. There are a number of options. We have a $120 million ask because it requires us to fulfill a number of things in the use of proceeds that gets us to where we want to go. The last point, because we are forward-leaning as a company, the number 2 person in the Department of Defense invited us in to talk to us about what we're proposing. We're in those discussions now. We're moving forward with Canadian partners and U.S. and UK and Australian partners. We invite you to talk to us about it because this is the future of the private sector in the United States. That's it. Thank you.
That concludes our presentations. Let's give it up for all of our awesome presenters, please. And they'll be at their tables for around a half an hour, and then we can continue the dialogue upstairs on the 8th floor. But mark your calendars for next Tuesday night, June 13th, Connect Tales. Hank Dearden at the front desk has a QR code. You guys can scan it on your phone and register. But it's a cocktail party, no presenters, but we have some exhibitors, and that's something that we do at CONNECTpreneur just to keep the community going in between our large events. But thank you guys all for coming out. We have the place till 10 o'clock, so we'll see you upstairs. We'll see you out there and then upstairs. Thank you.